Bull traps are one of the most common ways traders lose money, especially new ones. They happen when the market pretends to break out, luring buyers in, then reverses sharply and leaves them trapped at the top. You'll see this over and over again across stocks, forex, crypto, and commodities. The setup looks perfect, resistance breaks, momentum looks strong, maybe even a volume spike, but underneath the move isn't supported, and the moment buyers commit, the price flips the other way. It's the market's way of cleaning out weak hands and grabbing liquidity before the real move begins. In this video, we'll go through 6 real examples of bull traps, all pulled from live market charts. Each one shows the same story playing out in slightly different ways. Breakouts that fail, reversals that trap traders, and patterns that repeat over and over again. You'll see how these traps form around major resistance zones, range breakouts, and even within strong trends right before a reversal. By the end, you'll be able to spot the warning signs before they happen. Things like low volume breakouts, fake closes above resistance, and quick rejections back into the range. The goal here isn't to make you paranoid about every breakout, it's to help you recognize when price action isn't convincing. A breakout with real strength holds above the level, builds higher lows, and confirms the volume. A bull trap, on the other hand, does the opposite. It breaks, stalls, and snaps back. And once you see that in real time, you can stop being the liquidity and start trading with it. So as we go through each chart, focus on 3 things: where the breakout happens, how quickly it fails, and what the reversal looks like afterwards. Because these 6 setups are the exact patterns that repeat again and again. Whether you're trading Tesla, gold, or Bitcoin, the structure doesn't change. Here you can see price pushing up into a clear resistance zone that's been tested a few times before. Buyers start stepping in as it breaks above that level. Big green candle, looks like a breakout, maybe even a quick spike in volume. But notice what happens straight after. Price can't hold above resistance. In the second view, you can see the candle closing back below the breakout line. That's the first red flag. Momentum fades and early buyers are now trapped. On the third chart, the reversal confirms it. Sellers step in, price slides back into the range, and anyone who chased the breakout gets stopped out. It's a textbook bull trap. Breakout, failure to hold, and sharp reversal. Here we've got another classic bull trap. This time the breakout happens after a short pullback inside a weak uptrend. Price breaks above a recent high and looks like it's starting a new leg upward. You'll often see a candle close just above resistance, giving the illusion of strength. But look closely, the volume isn't there. Buyers step in late expecting continuation, but the momentum dies off almost instantly. The next candle drops straight back below the breakout point, closing under the same resistance line it just cleared. That's the moment the trap is sprung. Breakout buyers are now trapped on the wrong side of the move. From here, the market usually pulls back into the old range or even rolls over into a new downswing. It's the same pattern: weak breakout, no confirmation, quick reversal. Every time you see a breakout that can't hold its ground, that's your warning. The bulls are getting trapped. This setup shows a bull trap forming near the end of an extended uptrend. Price has been trending higher for a while, then pushes through that key resistance level, often right after a strong run of green candles. Traders see that breakout and assume momentum will keep going, but that's where exhaustion sets in. Volume is fading, RSI stretched, and the breakout candle closes right at the top of the move. In the next few bars you'll see hesitation, small wicks, lower closes, and then a sharp red candle that drops straight back below resistance. That failed pushes the trap. Buyers who entered late are now stuck as the trend reverses. From there, the chart usually shifts from higher highs to lower highs, the first sign the uptrend has topped out. This kind of bull trap doesn't just stop a rally, it often marks the beginning of a bigger correction. Here the bull trap forms inside a sideways market, a range that's been holding for a while. Price keeps bouncing between support and resistance, then finally breaks out above the top range. The breakout candle grabs attention fast. Traders assume the range is done and a new uptrend is starting. But there's no follow through. The next candle pulls straight back into the range, closing below the breakout line. That's the key. When a breakout can't hold above the structure, it's usually not a breakout, it's a trap. Buyers who jump in at the top now find themselves trapped as price slides back towards mid-range or even down to support. This pattern catches people over and over because range breakouts look clean, but if they fail on the retest, it's not continuation, it's rejection. Always wait for confirmation, otherwise you're buying the fake out, not the breakout. This bull trap is a great example of how candlestick signals can expose a false breakout early. Price breaks above resistance with what looks like a strong green candle, but then immediately prints a reversal candle, like a shooting star or a bearish engulfing. That single candle tells you everything. Buyers pushed up, but sellers took control before the close. It's a visual warning that a breakout was weak. The next few candles confirm it. Price starts drifting lower, and that breakout zone becomes resistance again. Traders who bought the breakout are now stuck, and as price falls, the stop losses get triggered, adding more selling pressure. This is one of the easiest traps to spot if you slow down and read the candles. Breakouts that end with a long wick and close back inside the structure. That's a textbook sign of trapped bulls. This final example shows how bull traps can appear in any market, stocks, forex, or even crypto. Here, price breaks above a clear resistance level after a period of sideways movement. It looks like the start of a breakout rally, but volume tells a different story. It's light and momentum isn't following through. Within a few candles, price stalls, prints a reversal pattern and drops straight back under the breakout line. That subtle reversal flushes out everyone who bought the breakout. Perfect liquidity grab before the next real move. You'll often see this pattern right before the bigger push in the opposite direction. What makes it dangerous is how convincing it looks. Every indicator screams bullish until it fails in real time. That's why waiting for confirmation is everything. A true breakout builds support above the level. A bull trap gives it up straight away. Every one of these charts tells the same story. Breakouts that look convincing but can't hold their ground. The key lesson is simple. Strength that doesn't sustain is weakness. When price breaks up but volume fades, or the next candle closes back below the structure, that's not confirmation, that's a trap. Spot those signs early and you'll stop being the liquidity for someone else's trade. Stay patient, wait for confirmation, and trade with the move, not against it. If you got something out of this one, chuck a like on it, hit subscribe and drop a comment below. Let me know what you want me to cover on the next video. Let me know what you want me to cover next. If you got something out of this one, chuck a like on it, hit subscribe and drop a comment below. Let me know what you want me to cover on the next one.